The world watches with bated breath as tensions between the United States and China continue to escalate. Trade wars simmer, technological competition intensifies, and geopolitical maneuvering keeps everyone on edge. Amid these swirling currents of uncertainty, one question looms large. What will China do with its massive holdings of U.S. Treasury bonds? China's ownership of approximately $760 billion in U.S. debt has become a strategic chess piece in the global financial game. The potential for China to weaponize these holdings, triggering economic chaos, is a constant source of speculation and anxiety. Yet despite the escalating tensions, China has refrained from any drastic moves, leaving experts to ponder the rationale behind this seemingly passive approach. The answer, as with most things involving geopolitics and high finance, is far from simple. China's decision is driven by a complex web of economic self-interest, global market dynamics, and a recognition of the potential for mutually assured economic destruction. Understanding China's calculus requires delving into the history of this financial entanglement, analyzing the potential consequences of a Chinese sell-off, and exploring the alternative investment avenues China might pursue. Only then can we begin to grasp the full scope of this high-stakes game and its potential impact on the future of the global economy. China's accumulation of U.S. Treasury bonds is not a recent phenomenon. It is the result of decades of economic policies and intertwined trade relationships. As China's economy boomed, fueled by exports, it found itself awash in U.S. dollars. These dollars, earned through trade surpluses, needed a safe and liquid investment haven. U.S. Treasury bonds, backed by the full faith and credit of the world's largest economy, provided the perfect solution. They offered a relatively safe and stable investment with guaranteed returns. This arrangement benefited both sides. China found a secure repository for its burgeoning dollar reserves, while the United States gained access to a vast pool of capital, keeping interest rates low and fueling economic growth. This symbiotic relationship, however, has become increasingly strained in recent years. As tensions rise, the once mutually beneficial arrangement has morphed into a potential source of leverage and vulnerability. The question is no longer whether this relationship is sustainable, but rather how long this delicate balance can hold. The world has watched with a mixture of fascination and trepidation as China has gradually reduced its holdings of U.S. Treasury bonds. This slow and calculated retreat is not driven by a desire to punish the United States, but rather by a pragmatic assessment of China's own economic self-interest. A sudden large-scale sell-off of U.S. Treasury bonds would be akin to China detonating an economic bomb in its own backyard. The immediate consequence would be a sharp decline in the value of China's remaining holdings, wiping out billions of dollars in value. Furthermore, such a move would trigger a domino effect across global markets. The U.S. dollar, the world's reserve currency, would plummet in value, sending shockwaves through international trade and finance. This instability would inevitably harm China's own export-dependent economy. China's reluctance to play the nuclear option of dumping its U.S. Treasury bonds stems from a calculated understanding of the potential fallout. The economic damage would be widespread and difficult to contain, ultimately hurting China as much as, if not more than, the United States. While China has so far resisted the temptation to engage in a full-fledged fire sale of U.S. Treasury bonds, the potential consequences of such a move are too significant to ignore. The impact would reverberate across the globe, affecting everything from interest rates and inflation to currency markets and global trade. One of the most immediate consequences would be a sharp rise in U.S. interest rates. As China sells off its bond holdings, flooding the market with U.S. debt, the price of these bonds would plummet. This, in turn, would drive up interest rates, making it more expensive for the U.S. government, businesses, and consumers to borrow money. The ripple effects would be felt across the U.S. economy, leading to slower economic growth, potentially tipping the country into a recession. Furthermore, the weakening dollar would make imports more expensive, fueling inflation and eroding purchasing power. The global financial system, already grappling with uncertainty and volatility, would be thrown into disarray. Emerging markets, heavily reliant on foreign capital, would be particularly vulnerable as investors seek safe havens. A Chinese sell-off of U.S. Treasury bonds would be a lose-lose scenario, triggering a global economic earthquake with far-reaching and unpredictable consequences. China's strategy with U.S. bonds. The decision for China to invest heavily in U.S. Treasury bonds is not merely a financial maneuver, but a calculated strategic move. At the heart of this strategy lies a blend of economic leverage and financial stability. Firstly, holding U.S. Treasury bonds provides China with a significant degree of economic leverage. By amassing such a large portion of U.S. debt, China wields considerable influence over the American economy. This leverage acts as a form of economic deterrent, a subtle yet powerful tool in international diplomacy. In essence, it ensures that economic relations between the two superpowers remain interdependent, reducing the likelihood of overt conflict. Secondly, these investments offer China a relatively safe and liquid asset. U.S. Treasury bonds are considered one of the safest investments globally, backed by the full faith and credit of the U.S. government. For China, this means a stable and predictable return on investment, crucial for maintaining its vast foreign exchange reserves. This financial stability is vital for a country with such a significant stake in global trade and investment. Furthermore, holding U.S. Treasury bonds helps China manage its own currency, the renminbi. By purchasing these bonds, China can control the value of the renminbi against the U.S. dollar, ensuring that Chinese exports remain competitively priced on the global market. This currency management is integral to China's economic strategy, supporting its export-driven growth model. In conclusion, China's strategy with U.S. Treasury bonds is multifaceted, blending economic leverage with financial stability and currency management. This intricate balancing act underscores the complexity of international finance and the delicate interdependence between the world's two largest economies. Stay tuned as we continue to explore the intricate financial dance between China and the United States in our next episode. As we delve deeper into the intricate financial dance between China and the United States, it becomes imperative to consider the future implications of their bond relationship. This chapter will explore the potential future scenarios and implications, considering both economic and geopolitical factors. One possible scenario is the continued status quo, where China maintains its significant holdings of U.S. Treasury bonds. This would ensure ongoing economic interdependence between the two superpowers, fostering a sense of stability in global financial markets. However, this stability is not without its challenges. The increasing national debt of the United States and potential shifts in global economic power dynamics could strain this delicate balance. Another potential outcome is a gradual diversification of China's foreign exchange reserves. As China's economy grows and matures, it may seek to reduce its reliance on U.S. Treasury bonds, investing in other assets, such as European bonds, gold, or even cryptocurrencies. This diversification could reduce China's vulnerability to U.S. economic policies and enhance its financial resilience. However, it could also lead to increased volatility in global markets, as the demand for U.S. bonds fluctuates. A more drastic scenario involves China significantly reducing its holdings of U.S. Treasury bonds. This move could be triggered by geopolitical tensions, economic conflicts, or shifts in global alliances. Such a sell-off could have profound implications, potentially destabilizing financial markets, increasing U.S. borrowing costs, and triggering a global economic crisis. The ripple effects of such an action would be felt worldwide, underscoring the interconnected nature of our global economy. In conclusion, the future of China-USA bond relations remains uncertain, with multiple scenarios possible. What is clear, however, is that this relationship will continue to play a pivotal role in shaping global economic and geopolitical landscapes. As we navigate these uncertain waters, understanding the complexities and potential outcomes of this bond relationship is crucial for policymakers, investors, and global citizens alike. As we ponder the future implications of China-USA bond relations, it's essential to understand why China isn't selling its U.S. Treasury bonds outright and what it plans to achieve with this strategic patience. China's decision to hold on to its vast reserves of U.S. Treasury bonds isn't merely a financial calculation, it reflects a broader, more nuanced strategy aimed at long-term geopolitical and economic goals. By maintaining its bond holdings, China ensures a degree of economic stability and leverage over the United States. This leverage can be crucial in trade negotiations and other diplomatic arenas, allowing China to exert influence without direct confrontation. Moreover, a sudden sell-off of U.S. bonds would likely destabilize global financial markets, an outcome that would harm not just the United States, but also China's economy. The interconnected nature of global finance means that a shock in one major economy can ripple through others, causing unintended consequences that could undermine China's growth and stability. China's patience also aligns with its broader vision of gradually shifting its economic focus. By slowly diversifying its foreign exchange reserves, China aims to reduce its reliance on U.S. assets while minimizing market disruption. This measured approach allows China to invest in other global assets, such as European bonds, gold, and emerging market investments, gradually building a more resilient and diversified portfolio. In the long term, China's strategy might also include fostering the internationalization of its own currency, the yuan. By promoting the yuan as a global reserve currency, China could reduce its dependence on the US dollar, thereby enhancing its financial sovereignty. This strategic patience is a calculated move towards a future where China plays a more dominant role in global finance without triggering immediate economic instability. In conclusion, China's decision to hold on to U.S. Treasury bonds is a testament to its strategic patience and long-term vision. By carefully balancing its economic interests and geopolitical goals, China is positioning itself for a future where it can navigate the complexities of global finance with greater agility and influence. Understanding this strategy is crucial for anyone looking to grasp the evolving dynamics of global power and economic relations. While China's strategic patience with U.S. Treasury bonds is evident, what if this patience wears thin? What would happen if China decided to sell off its U.S. Treasury holdings? The potential impact on U.S. stocks and inflation could be significant, creating ripples across the entire American economy. Firstly, a large-scale sell-off would likely lead to a spike in U.S. interest rates. As China offloads its bonds, the increased supply would push bond prices down and yields up. Higher yields on Treasury bonds would make borrowing more expensive for consumers and businesses alike. This could slow down economic growth as loans for homes, cars, and business expansion become costlier. The stock market would not be immune to these changes. Higher interest rates often lead to lower stock prices, as the cost of financing rises and future earnings are discounted more heavily. Investors might seek safer, higher-yielding assets, pulling money out of the stock market and causing a decline in stock prices. The resulting market volatility could erode investor confidence, further exacerbating the downturn. Moreover, the U.S. economy could face inflationary pressures. As interest rates rise, the cost of goods and services might increase, leading to higher consumer prices. This inflationary trend could squeeze household budgets, reducing disposable income and dampening consumer spending, a critical driver of the U.S. economy. In a broader sense, the stability of the U.S. financial system could be at risk. A sudden influx of U.S. Treasury bonds in the market could lead to a liquidity crunch, straining financial institutions and potentially triggering a credit crisis. The interconnected nature of global finance means that these shocks wouldn't be confined to the U.S. alone, but could reverberate through international markets. Ultimately, the potential sell-off of U.S. Treasury bonds by China would be a high-stakes gamble with far-reaching consequences. It underscores the delicate balance of global economic relations and the profound interconnectedness of modern financial systems. While such a scenario remains hypothetical, understanding its implications helps us appreciate the intricate dance of economic power and geopolitical strategy at play. In conclusion, the decision by China to sell off its U.S. Treasury bonds would send shockwaves through the U.S. economy, affecting everything from stock market stability to inflation and overall economic health. As we continue to monitor these complex dynamics, it's clear that the financial ties between the U.S. and China are both a source of strength and a potential vulnerability in the global economic landscape. While the potential fallout of a Chinese sell-off of U.S. Treasury bonds is daunting, it's essential to also consider the possible gains and losses for the USA in such a scenario. This chapter will explore the economic impacts, market reactions, and long-term consequences if China decides to divest its U.S. Treasury holdings. On the one hand, a large-scale sell-off could create significant challenges for the U.S. economy. As previously discussed, higher interest rates could slow economic growth, dampen consumer spending, and lead to market volatility. But what about the potential benefits? One potential gain could be a recalibration of U.S. monetary policy. With China no longer holding a substantial portion of U.S. debt, the Federal Reserve might have more flexibility in managing interest rates and implementing monetary policies that best suit domestic needs. This autonomy could help the USA better navigate economic cycles without the added pressure of foreign bondholders. Additionally, a sell-off could prompt the U.S. government to address its fiscal policies more diligently. The sudden reduction in demand for Treasury bonds might force policymakers to consider more sustainable budget practices, potentially reducing the national debt over the long term. This could lead to a more balanced and resilient economic framework. However, the immediate drawbacks cannot be ignored. The initial shock of a sell-off could lead to a liquidity crisis, straining financial institutions and potentially triggering a credit crunch. The broader economy might face inflationary pressures, further squeezing household budgets and reducing disposable income. In the long term, the U.S. might also need to seek alternative buyers for its debt, potentially at higher interest rates. This could increase the cost of borrowing for the government, impacting public spending on critical programs and infrastructure projects. Moreover, the geopolitical implications of such a move would be profound. The financial ties between the U.S. and China are a cornerstone of global economic stability. A significant shift in this relationship could lead to increased tensions and a re-evaluation of trade and economic policies on both sides. In conclusion, while the USA might gain some policy flexibility and fiscal discipline from a Chinese bond sell-off, the immediate economic and market impacts could be severe. Understanding these dynamics is crucial as we navigate the complex interplay of global economic power and strategy. The future of U.S.-China financial relations remains uncertain, but one thing is clear: the interconnectedness of our economies makes any significant shift a high-stakes gamble with far-reaching consequences. As we consider the potential outcomes of a Chinese sell-off of U.S. Treasury bonds, one question looms large: what would China do with the proceeds? First, let's explore the possibility of China reinvesting in its own economy. With a significant influx of capital, China could boost domestic infrastructure projects, enhance technological innovation, and support key industries. This inward investment could further China's economic growth and bolster its position as a global economic powerhouse. By focusing on high-tech sectors, green energy initiatives, and modernizing its urban infrastructure, China could accelerate its transition into a more advanced and self-sufficient economy. Alternatively, China might look beyond its borders to diversify its investment portfolio. One likely avenue is increasing its holdings in other countries' government bonds. European bonds, for instance, could be an attractive option due to the stability of the Eurozone. Investing in bonds from countries like Germany, France, and the UK could offer China a balanced and secure return. Moreover, these investments would strengthen economic ties with key trading partners, potentially giving China more influence in international financial markets. Emerging markets could also present lucrative opportunities. By investing in the bonds of developing nations, China could support the growth of these economies while securing higher yields compared to more established markets. Countries in Africa, Latin America, and Southeast Asia could benefit from this influx of capital, enhancing their infrastructure and economic development. This strategy aligns with China's Belt and Road Initiative, which aims to expand its global economic footprint. Another strategic move could involve investing in assets like gold and other commodities. Diversifying into tangible assets would provide China with a hedge against currency fluctuations and economic instability. Additionally, China could increase its stake in multinational corporations and strategic industries worldwide, further cementing its global influence. In conclusion, the proceeds from selling U.S. Treasury bonds could be channeled into various avenues, each with its own set of benefits and strategic implications. Whether reinvesting domestically, diversifying into international bonds, or exploring alternative assets, China's decisions will undoubtedly shape the future landscape of global finance. As the world watches closely, the choices made by China's financial architects will reveal much about the country's long-term economic vision and its role in the evolving global order. As we delve into the potential outcomes of China selling off its U.S. Treasury bonds, an essential question arises: will other countries follow suit? This chapter explores the possible ripple effect on global bond markets if China decides to liquidate its U.S. Treasury holdings. Imagine a scenario where China initiates a massive sell-off. Such a move would not only send shockwaves through the global financial system, but also prompt other major bond-holding countries to reassess their positions. Nations like Japan, the United Kingdom, and oil-rich countries in the Middle East, which collectively hold substantial amounts of U.S. debt, might feel compelled to act. The initial reaction could be a surge in bond yields, as the market struggles to absorb the sudden increase in supply. Higher yields would make borrowing more expensive for the US government, potentially leading to higher interest rates for consumers and businesses. But the implications don't stop there. If major economies start dumping their US Treasury bonds, global investors might lose confidence in the stability of the US dollar. This could lead to a depreciation of the dollar, affecting international trade and causing volatility in currency markets worldwide. Moreover, countries heavily invested in US bonds might shift their focus to other assets, such as European bonds, emerging market securities, or even gold. This diversification could alter the dynamics of global capital flows, leading to increased demand and higher valuations for these alternative investments. In turn, the US might experience capital outflows, putting additional strain on its financial markets. The Federal Reserve could be forced to intervene, potentially by buying back bonds to stabilize the market. But such actions come with their own set of risks and consequences. Ultimately, the decision by China to sell off its US Treasury bonds could set off a chain reaction, prompting other nations to reevaluate their bond portfolios and triggering widespread economic repercussions. As global financial markets brace for such a possibility, the interconnected nature of today's economy means that the impact of China's actions will be felt far and wide. In conclusion, the potential for other countries to start dumping bonds if China sells its US Treasury holdings is a scenario fraught with complexities and uncertainties. The global bond market, already a delicate balancing act, could be thrown into disarray, underscoring the far-reaching influence of China's financial strategies. As we move deeper into the potential repercussions of China's sell-off of US Treasury bonds, a critical question emerges. Will this action accelerate the global trend towards de-dollarization? De-dollarization refers to the process of countries reducing their reliance on the US dollar for international trade and finance. If China decides to liquidate its US bond holdings, it could catalyze this shift, prompting countries to seek alternatives to the dollar-dominated financial system. This move could have far-reaching consequences, altering the very fabric of global trade and investment. But that's not the only factor at play. We must also consider the impact of former President Trump's policies. Many of his economic and foreign policies have been perceived as protectionist and unilateral, pushing countries to explore new alliances and economic partnerships. One such alliance is BRICS, an economic bloc comprising Brazil, Russia, India, China, and South Africa. BRICS represents a significant challenge to the dominance of the US dollar. With its member countries collectively accounting for a substantial portion of global GDP, the bloc has the potential to reshape the international financial landscape. If nations within BRICS and beyond begin to favor their own currencies or other alternatives over the US dollar, the global balance of economic power could shift dramatically. This trend towards de-dollarization and the strengthening of economic alliances like BRICS could have profound implications. For the US, it might mean a reduced ability to influence global financial markets and a potential decline in the dollar's value. For other countries, it could signal greater economic independence and a more multipolar world economy. In conclusion, the potential sell-off of US Treasury bonds by China, combined with the broader geopolitical shifts influenced by Trump's policies, could accelerate the move towards de-dollarization and strengthen blocs like BRICS. These developments could fundamentally alter the global financial order, ushering in a new era of economic relationships and power dynamics. Stay tuned as we continue to explore the intricate web of global finance and the ever-evolving strategies of major economic players.